And now please allow me to introduce our speakers, Ollin and Scotty Sykes. Ollin received his BS in Business Administration from Mars Hill College in 1972, his CPA certification in 1975, and his Certified Management Accountant certification in 1980. Ollin began his career in 1973, and since 1984, he has served as president of Sykes & Company, PA, an accounting firm specializing in accounting, tax, and financial advisory services for independent retail pharmacies. Ollin is joined by Scotty. Scotty received his CPA certification in 2011 and his Certified Financial Planner certification in 2019. He received his bachelor's degree in Business Administration and master's degree in accountancy from the University of North Carolina at Wilmington. So with that, I will turn it over to you, Ollin and Scotty.
Well, appreciate the opportunity to be with everybody today. I'm Ollin Sykes. Scott is with me today, and we provide tax mitigation, tax compliance, and cloud-based accounting services for pharmacies exclusively all over the country. We currently work with hundreds of pharmacies, and we're glad to be with you today.
Yep, pleasure to be here today. All right, so we're going to go through, we're going to talk about best practices for pharmacy accounting, which is critical to understanding key performance indicators for pharmacies, and which we're going to go over those key top performance indicators. We're going to discuss opportunities to enhance pharmacy cash flow and valuation along the way as well. So quite a bit to cover. And so we're going to dive right into fundamental accounting. And the reason why we always start presentations really with this information is because we see so many pharmacies that don't have it. And those pharmacies that do not have this fundamental accounting, we see really struggle, and they don't know what's going on, or they don't know why. And when we take a look, we see, well, you don't have a balance sheet that's been updated in, who knows how long. So, when you don't have fundamental information, you don't know what you really don't know what you're doing and where you're going and what you need to be working on. So this fundamental accounting is so important. And the successful pharmacies out there today, they have got a strong accounting system, let me tell you. And they use that accounting system constantly. They're always looking at their numbers. They're understanding what their costs are, their margins are, what their inventory is, et cetera, et cetera. So, this strong accounting foundation is very important. It will help you outperform industry averages because you'll see what your averages are, and then how you can maybe outperform averages, what other pharmacies are doing to outperform those industry averages. Only those numbers can kind of give you that feedback. And just the pharmacy industry in general requires a sound accounting foundation, a sound accounting system. When you're talking about pharmacies, you're filling, adjudicating a script. You're not getting paid for about 19 to 21 days on average, but your wholesaler bill's due in 10 or 15 days. So you're paying your outflows for the wholesaler is going out before your inflow from third parties, and that's a natural cash flow crunch there in a pharmacy, and it's just inherent in the industry. So you got to understand these moving pieces, how they all work, to grasp that concept, and then you can really plan around it and how you can plan to mitigate that cash flow crunch there. And again, a common theme with struggling pharmacies really is that the fundamentals aren't there. So you don't want to be in that position, and we're going to help you hopefully identify those areas on how to get that accounting system up and running.
And Scotty, this fundamental information we're talking about is critical so that you've got real-time information provided to you. What is real-time information? That's not only knowing what your bank account balance is and what you owe to your third parties, whether it's your wholesaler or other bills that you might owe, but it's making sure that you understand where your receivables are, what your inventory balances are, what your note balances are. It allows you to be proactive in managing the business instead of it managing you. It also provides insight into trends, weaknesses, strengths. Obviously, key performance indicators come into play on this very critically. Clearly, it opens the door to tax mitigation tax planning, and facilitates tax compliance at year end. Technology drives this fundamental system to give you the data you need and timely. There's tremendous technology cloud-based tools that are out there that allow you the opportunity to have this information using artificial intelligence and business machine learning language to facilitate the entire process, so that you don't necessarily have to pay somebody to sit in the back of your pharmacy, writing checks and creating documents. That's the way it used to be done. And obviously provides opportunity for pharmacy owners to shift to your patient care and growth and loving your patients and taking care of them, not dealing with that back office or wondering where things are.
Yeah, and if you're coming out of the COVID crisis we've all been dealing with, this is a great area to really kind of hit the reset button, as a lot of people are doing, and start with this fundamental accounting system, get it where it needs to be, get some solid numbers, understand what's going on, and then you can really drive your future instead of just riding along. And we're going to go through the really the key processes of what is a accounting system, a fundamental accounting system, and it's really these daily processes, these daily and weekly processes, I should say.
Yeah, and Scotty, these are really best practices we would use in normal pharmacy arrangements with independent retail pharmacies. So this is just not words. This is a real life situations that we're involved in on an ongoing basis.
Yep, and it's again, these procedures are very important from an accounting standpoint, from a management standpoint, but also when you're talking about internal control, theft, misappropriation of funds. These daily processes and procedures that you would implement help mitigate that. And so we're talking about daily point of sale reporting and bank reconciliation, capturing what's coming out of the point of sale registers daily, tying it into the bank account, making sure everything's reconciling there. If you had $300 in cash, that you're seeing that $300 in cash go into the bank the next day. Payroll enhancements using technology. We're a CPA firm of about 45 folks, and we don't even do our own payroll because it's so efficient and cost effective using technology and outsourcing that. And not to mention all the controls that come with that, fingerprints, the time clocks, and all that. So you can really enhance your payroll process from that standpoint. Accounts payable automation is also another key factor using technology. Scanning bills, paying them with a couple clicks of a button, having a digital online filing system. These things are key factors into a comprehensive fundamental accounting system.
And you might say, well, I think I've got my internal controls where I need them to be. I make deposits once or twice a week, but why not daily? I mean, if people are handling that point of sale report for you, preparing a deposit, you need to be tracking to make sure those deposits literally made it to the bank. Are you checking that once a day or every other day as those deposits to make sure that the cash deposited ties back in to what the point of sale system says? If you're not, you don't have a control on that. And also refunds. I mean, how many clerks or techs or other pharmacists in your pharmacy are allowed to hit the refund key and give out money to customers? Is it verified by the PIC or you as the owner? These are kinds of things we have seen literally hundreds of thousands of dollars dissipate from pharmacies in a period of 3 to 6 months. And when you don't have these basic controls, checks and balances in process coming out of that daily point of sale reporting system, tying into the bank reconciliation and the banking situation, you don't have control over that. And this is a critical area for pharmacies.
Mm-hmm. And these areas here are going to give you those fundamental numbers, the revenues, the accurate revenue numbers, the expenses as far as payroll, the accounts payable as well, that what's on those balance sheet items. So, these are fundamental parts of that balance sheet as well. And the balance sheet here is I will say one of the most critical components of the accounting system, or the accounting financial statements you will see. You need to understand your balance. If you've never looked at a balance sheet or never really understood your balance sheet, you need to understand this balance sheet, because an accurate balance sheet will ensure an accurate profit and loss statement. So if you're just going in, say, QuickBooks or whatever system you're using and printing out a P&L, out of that system. You know, if that balance sheet doesn't tie in every line item there, what you're looking at doesn't have a whole lot of value, if any. So understand this balance sheet line by line before you dive into that P&L, and you're going to be confident what you're looking at on the P&L is accurate. The balance sheet is your assets, and then it's going to include your liabilities and equity, and assets equals liabilities plus equity. Assets will be, you know, cash, receivables, inventory, fixed assets, and we're going to dive into these items in particular here in a little bit. But those are your assets. Your liabilities will include accounts payable, any notes payable to the bank, for example, or maybe a car note you have on there, you're paying a car payment, any sales tax payable. And of course, your equity is what you've really built into the business that you've kind of retained over the years. Will include your retained earnings, any capital you've injected into the pharmacy, and any money you've taken out as distributions or draws as well will decrease that equity balance. Again, these numbers are important to tie in for ratio analysis, key performance indicators. I can't stress enough how important your balance sheet is. So we talked about those daily processes because they impact your balance sheet, they impact your P&L, they impact the controls, just the basic cash controls as well. They streamline the back office. They give you that real-time information. The next real part as part of the balance sheet is going to be these third-party receivables. And this is a major component of the balance sheet. This is money that's owed to the pharmacy. When you adjudicate a script, that adjudicated script there, that's money owed to the pharmacy from PBM third parties. And so what we typically have seen in the past, which is the norm, is that pharmacies really don't have any clue what's owed to them at any given point in time from PBMs and third parties. So this is what we call the largest unreconciled bank account in a pharmacy. And you really need to get a grasp on what the pharmacy's owed. You need to understand what your pharmacy is owed at any given point in time from these third parties, and you need to make sure that number is getting into your accounting system. It's going to give you the accurate revenue numbers. It's going to give you key performance indicators that you need to understand.
But Scotty, what we hear a lot of times is, well, I'm paying one of the popular third-party reconciliation systems to do this for me. Why do I need to do this if I'm paying them? And let me give you that answer. That answer is they are going to take control essentially of most of your third-party payers. Some cases, not all of those will be included in these reports for different reasons. But obviously, you're getting automated ACH payments, and you're getting, in some cases, hopefully not too many, paper checks. If you don't get the paper checks back to these third-party reconciliation systems, and if you don't verify your 835s that come in on a regular and continuous basis, as you pull up these aging reports from your third-party reconciliation systems, then the value you have and the reports that you're seeing will be absolutely worthless to you. And we see that in many cases where people will pay the fees, they'll have these third-party reporting reconciliation systems, but they won't verify deposits. They don't get them paper checks that come in. They don't get the 835s, and they have somebody in the store spend 10 to 15 minutes several times a week verifying that. And as a result, the receivables are totally out of control. I talked to a pharmacy just yesterday who had reported millions and millions of dollars in the last 18 months that are on the third-party receivable system. They have reported for tax purposes in error and have just figured this out. And they just figured it out once they went to a third-party reporting system. After being in business for 18 months, they didn't have one. Then they got one. Then they didn't realize what they had to do with it. They didn't get trained properly. It became a nightmare. And now they're paying us to get this fixed. This is crazy. I mean, again, this is your largest unreconciled bank account balance, and if you don't manage it on a daily basis, as you would your bank account, you can lose sight of this very quickly, and you won't have proper revenue to report on your P&L. You won't have proper receivable balances at month end, and tax information that you use for filing purposes is going to be totally in error.
Yep, and KPIs will be out of whack. Your KPIs won't be accurate. You'll be comparing yourself to KPIs that have this information. So, recommend that you first find out if you have a reconciliation system. If you do, great. Go in there, put procedures in place on how to manage it. Contact a account representative with the system. Learn what the best practices are for that system. Implement those best practices. Pull those reports weekly. Understand what's owed to you. Make sure that those numbers are getting into the accounting system at least on a monthly basis with an adjusting journal entry. And make sure your accountant is getting that information. And then hopefully, you're going to have some accurate revenue numbers, accurate bottom line on the P&L, et cetera. So just very important component here that you need to have an understanding on for sure.
And one other thing, we like to make sure that at least 95% of your outstanding receivables are shown on that aging report under 60 days. Under 60 days. Because once you get beyond 60 days, the chances of recovery of that claim or tracking down a problematic outstanding claim becomes really an issue sometimes. And you get out beyond 90, 120 days, it becomes a lost cause. And this is money that you've already paid cost of sales for and have a substantial investment in that you need to be receiving. And why would you not want to track it? But yet many pharmacies don't put any credibility or credence or time involved in what we've just talked about for the last 5 minutes in whatsoever.
And I'll tell you that there's several instances where these systems have found some significant errors with payments, et cetera, and thousands of dollars have been recouped. So these systems really pay for themselves. They're very inexpensive from that standpoint. So not to mention, you're going to pull these systems pull the 835s and pull those line items. So you're able to get DIR, GR, BER fees, those other adjudication costs, which you can then take that information because they pull reports for that as well. Most of them do. And you can put that information in your accounting file. And then you can track your fees as compared to, say, industry averages, et cetera. And that's a major key data point, as we're going to see. So there's other benefits to this as well, not just knowing what's paid to you, capturing monies that maybe are owed to you that have been missed, et cetera. But the reporting is fantastic as well.
And some of the systems will have kind of a premium level where they will track down claims that come back, let's say $15 off. Some others will not track those amounts. So you need to check with the system that you're using to make sure that you have perhaps the premium level service, that they will track down claims that come back with larger differences. I've literally seen a $40,000 claim before being found with systems like that. And I've seen systems where they don't have those premium services, the money goes wash and is never found. So these systems will pay for themselves over time used properly.
All right, the next key component of your balance sheet. So we've talked about kind of the bank account and the daily processes there. We've talked about these third-party receivables, which is an asset owed to the pharmacy, major asset. The other major item here is inventory. Major asset is going to be inventory. And I can't tell you how many times I've looked at a tax return for pharmacy and the inventory numbers never change from one tax year to the next. The same inventory number, which is just should not be the case. This inventory is the biggest cash flow opportunity in pharmacy, really, what we're seeing today, other than third-party receivable. How you manage inventory, how you understand inventory can pay tremendous dividends as far as from a cash flow standpoint, as far as a margin standpoint, et cetera. Pharmacies that average around 11 turns a year, they had their metrics compared to those pharmacies that turn 20 plus turns a year are completely night and day. The pharmacies that really take inventory management seriously, understand their reorder points, understand their demand, use technology, etc. They really can make these turns, keep inventory moving, and really generate that cash flow that's so important in pharmacy, which we all know is extremely important. So, huge opportunity here. Now, the inventory turn is a key metric here. It's going to be cost of goods divided by your average inventory for whatever period you're looking at. And, again, the average is about 11 turns a year, which frankly is about rock bottom. When we're thinking about the wholesalers can really turn around inventory next day ordering, get it to the pharmacy the next day. You've got technologies out there that can help you with reorder points, what you need to have on the shelves, etc. You should be at least be at 15 turns a year. 20 would be a great goal. But these are $100 bills on the shelf. This is some serious money when you start looking at it. And even more reason why these 20 plus turns can really add up quickly for your bottom line and for your cash
Well,
flow.
as the old saying goes, these are not Andrew Jacksons sitting on the shelf, they're Benjamin Franklins. And I will tell you this, the high performing pharmacies we deal with, I can think of several that have 27 or 28 turns a year. An incredible thought to think that. But these pharmacies are extraordinarily profitable, have margins that are unreal, have cash flows that are through the roof as a result of this optimization that they have with the inventory process. And again, with the technology that's out there today, with artificial intelligence, and again, some of the products that are on the marketplace that will automatically handle a lot of this for you, it still doesn't mean that human interference into the process is so very critical, because a lot of times these machines will determine your reorder points, and they'll have something that's off just a little bit, and it can vary dramatically in the amount of inventory or purchases that it makes. So we always like to say that each and every day before your automatic ordering goes in, either the PIC or the owner in the pharmacy needs to just make sure that the ordering process that's coming from any computerized systems are adequate and appropriate.
Yeah, and not understanding how this all works, if you just take your accountant's advice, I've seen instances where the accountant or tax preparer has essentially overstated inventory by $1 million, and clearly when that happens, income's overstated by $1 million, and you're going to have tax on that $1 million of income. And so this is very important, not only from a management, from a cash flow perspective, but also from a tax perspective. Because if someone along the lines is not paying attention and you overstate your inventory for tax purposes, you're going to be paying tax on phantom income, really, is what it is. So, you got to pay attention to that. And inventory on your balance sheet is very important. We adjust monthly here for financial statement purposes, and everybody else should be doing that as well, because you're going to adjust that inventory to what's actual at the end of each month. Hopefully you got a perpetual system in place. You're using that perpetual system. It's accurate. The cost uploads are accurate. You're doing periodic cycle counts. If you're really comfortable with that periodic or that perpetual inventory system, you need to be getting that in your financial statements, adjusting those inventory numbers, adjusting your cost of goods. Therefore, you're going to get accurate margin. You're going to get accurate cost of goods, accurate margin, gross margin, and you're going to know what your gross margin is as compared to your peers in the industry, which is clearly the number one key performance indicator, is your gross margin. Which is in the range of 23-24% today. And if your inventory is understated or overstated, that margin is going to be off, and you're going to be comparing yourself to numbers that aren't correct. So you got to be very careful here and get this inventory number accurate, get it into the accounting system.
And so, I often wonder why we only see about half of the pharmacies with perpetual inventory systems, because essentially what that means is about half of them don't know really what their inventory levels are. They don't have optimum ordering processes in place. They don't really know and have accurate financial information on an interim month by month basis. This is not something you can do quarterly. It needs to be done month to month, especially in this environment. They don't have accurate gross profits, much less accurate net income pre-tax. So this inventory, as well as the receivable adjustments, dramatically impact your P&L and your gross margins. And as Scotty mentioned a minute ago, the most important number on your P&L really is that gross margin net of rebates. And you really are not going to be able to properly determine what that gross margin is if we're not recording DR fees through our third-party reporting system and we don't have accurate inventory. So these are so critical. It's so fundamental to making sure that you know where your pharmacy is and what you're doing so you can be proactive in managing that pharmacy. So that bank account is not managing you, you're managing it. That's what it's all about. You've got to manage that process, and it's managed through all these ancillary balance sheet items that are so critical.
Yeah, that's a great point. So again, these we talked about perpetual inventory, how important that is. You know, the top performing pharmacies have a perpetual system and they maintain it. They watch over it. They get good numbers out of it. They tie it into their financial statements. You know, these are things you should be doing here. There are inventory specialists out there as well that deal with pharmacy inventory. They have a tremendous amount of value as well. So if that's ever something, you know, you should consider that as well. You know, MedSync is a huge one as well. You know, you got some pharmacies where they literally order X dollars of cost of goods. It comes in, and before it doesn't even go on the shelf, it goes out of the box into the bottle out the door. They're not even putting stuff on the shelf. They're turning stuff so well, and they've got things dialed in so good. So when you think about that, their cash flow crunch really shrinks. You know, they're getting it in and it's going right back out and they're selling it. So that really shrinks that inherent cash flow issue I was talking about in the very beginning. And those accurate cost downloads are very important, especially if you're using that information in your financial statements.
You know, Scotty, talking about your synchronization, also, you know, your MedSync products and services that you're using are going to do nothing but to help your star ratings. And we know from experience that if you have star ratings averaging 5.0, then your DR fees are going to be the lowest of anybody. We see DR fees under 2% for those pharmacies that have average star ratings of 5. And we see some that have star ratings of 4 or under that have DR fees of 4.5%. And when you're running 4 million, 5 million, 6 million, whatever sales you got annually, 1 or 2 percentage points can make a humongous difference. And you need to be staying all over this with respect to these kinds of tools that are out there. And also, we didn't mention that even if you have perpetual inventory, you need to be doing periodic cycle counts. So that means if you got 4 shelves, then maybe once a quarter, you have your techs count one shelf and verify that back to your system to verify what's in the system. Very pure and simple. Then you don't have to take necessarily an actual physical account at the end of the year if you're doing it, say, over the course of the year. So all these tools and all these systems are trying to maximize cash, maximize turns, maximize margin and profitability, pure and simple.
Yep. So once you have these items in place, you know, then you can really start, and everything we've talked about up to this point, then you can really start and understand your profit and loss, rely on your profit and loss, and gather the information that is telling you. But if you're missing these components we've just gone over, you're going to have gaps here, and you're going to be reviewing information that's not accurate. So again, very important those items are there. So once they are there, you're going to have revenues, expenses, your gross margin, your net income loss, etc. Those balance sheet adjustments directly affect profit and loss, the inventory. You know, if there's an increase or decrease in inventory, that increases or decreases cost of goods. If there's an increase or decrease in third-party receivables, that increase or decreases your third-party receivables income, revenue, I should say. So they have a direct effect there. Let's see, we've talked about most of that. Let's go to the next one here. So that gross margin is directly impacted by those inventory levels on the balance sheet. So again, when we see pharmacies that have the same inventory, $150,000 inventory number on the tax return for 3 or 4 years, you have to wonder how accurate that margin is, and you can't rely on what you're seeing there. So you don't want to be in that boat. You want to get those accurate inventory numbers in your system to understand your gross margin. And that gross margin, again, is the most important figure on that profit and loss. You got to understand what that margin is. If you're below average, why? If you're above average, what are you doing different? Is it a behind the bench issue if you're below average? What is it? So you got, this will allow you to then ask questions on what's going on, dig deeper, manage the pharmacy, and make adjustments if need be.
And Scotty, if your inventory is all $50,000, that means your cost of goods sold is all $50,000. It means your gross profit's all 50. So and if it's, whether it's higher or lower, it has a direct impact on your cost of goods sold, and in turn, what your gross margin is going to be showing. So that's why we want to make sure inventory are as accurate as they possibly can be. And as we've mentioned here several times, we're looking at gross margins plus or minus 23% net of rebates. And I will tell you, we have many pharmacies that are running in the high 20s that are typical independent retail pharmacies. We have other pharmacies that are 20% or less, and they're struggling mightily. And you have to ask, why are these pharmacies below average? Does it deal with the lack of accounting integrity, which is affecting the fundamental aspects of the system? Is it totally PBM related? Is it another reason? We need to know. And unless you have these items that are tied in, unless you're reporting DR fees and recording DR fees on your books and adjudication costs, which is substantial, keep it in mind that when you get when you get your ACH payments in, they're coming in net of DR fees and adjudication costs. And if you don't take those reports and adjust your revenue higher for the month and then offset that with the actual DR fees as an expense, then you're not going to have accurate revenue. You're not going to have accurate gross margin or accurate expenses. So just something of that nature. And again, DR fees now is about the number 3 most important number that we're seeing on the financial statements now. Number 1 being gross margin, number 2 being payroll and benefits as a percentage of total revenue, and number 3 being DR fees. If you have those 3 that are not where they need to be, you don't stand a chance at bringing your bottom line down to where it needs to be in today's environment with reimbursements what they are. And you cannot have that accurate information to be able to tell what those numbers are unless you get these items we've talked about for the last 30 minutes in place. The receivables, the cash, the inventory, fixed asset depreciation, and have the accounts payable recorded correctly. If this information on the balance sheet is incorrect, your P&L becomes not worth the piece of paper that it's printed upon. Now, if you're using QuickBooks to just record your receipts and disbursements, it's a waste of time. Just a complete waste of time.
Yeah, and with technology today, you can share the accounting system seamless 24/7. All parties working have access to it, so there's no reason why you shouldn't have a robust accounting system per se that's up to date constantly, and everybody's working in it at the same time. And so these things are definitely doable, and you have to do these things. And today, the pharmacy industry is just it's tough, it's difficult. You got to know what you're doing. You got to know why you're doing what you're doing and what you need to be doing differently, if anything, to outperform and to have a healthy bottom line like a lot of pharmacies do. And again, these fundamentals are key to doing that.
Yeah, you got to be proactive with this stuff, Scotty. And you can't just sit around and blame the PBMs. I hear a lot of that, and there's a certain amount of that that's valid, but it's also a certain amount of that folks are not being proactive in keeping good, solid fundamental data.
Mhm. And a great, a great spin off of that is the revenue diversification. We see a lot of pharmacies out there that aren't going to sit back, and they're not going to, just take what the PBMs give them and go with it, and sit in the room and maybe complain about it. They're going to go out there and say, all right, what does my community need? How can I find a niche in my community? What products are they? What services are they? Is it clinical? Is it vaccinations? What is it that can set me apart in this community? What relationships can I build with providers in my area, et cetera, et cetera, et cetera? You got to be forward thinking here. You got to diversify. You got to look towards being that wellness center pharmacy. And these fundamentals are going to, help you determine, hey, is that stuff working? Is it not working? Is it adding to my bottom line? Is it increasing my margin to 26% rather than 23%, 24%? So just there's so much you can do with solid information.
And, an example would be a 340B program. I can't tell you the number of pharmacies I talk to that don't know anything about 340B programs in their communities. They never even heard about it. Well, my goodness, you need to reach out to your clinic, to your clinics, to your hospitals, to your nonprofit agencies, and find out what's available out there. And for a lot of times, folks are presented a 340B contract from an institution, and they just accept it. You don't ever want to do that. You want to. They've got a consultant that's writing those, not necessarily in your favor. So you've got to reach out and find those that are in the 340B industry to help you counteract and make it become a win-win arrangement, even in a 340B arrangement. But we've got pharmacies killing it with 340Bs and killing it with other types of clinical services, whether it's nutraceuticals, CBD. And we got a client selling $90,000 of CBD a month, and we've got other clients not selling CBD at all. So there are huge differences in philosophies, obviously, concepts and shareholders' thoughts about how they run pharmacies, whether they're looking to be proactive or not. But these are the kinds of things that are just so critical. And as we get to the key performance indicators here that we're talking about, we've talked about these average inventory turns at 11. You don't want to be at 11. You want to be at 20 or above if at all possible. Your third party outstanding days, roughly 3 weeks, give or take. Yours may be quicker. Yours may be longer than that. Depends on what your third parties are in your particular area and region that you are adjudicating claims. Your average current ratio, what's that? That's essentially your cash, your receivables, and your inventory, which are your current assets. Those are assets that turn over very quickly, divided by your accounts payable and debt that's due in the next 12 months, or current liabilities. That current ratio, typically we want it to be at least 2.5 to 1, meaning you got $2.5 of cash, receivables, and inventory for every dollar of short-term debt that you have. I looked at one earlier this morning. The gentleman has a ratio of about 6 to 1. He's exceptional. We have many pharmacies that have under 2 to 1, and occasionally we run into pharmacies that have less than 1 to 1. They're in trouble. I don't need to tell you. So it's a litmus test of how what shape pharmacies are in by the amount of liquidity they have. And in this COVID environment that we're operating in, especially what's taking place in the last couple of months, cash is king, folks. Whether it's cash is tied up in receivables or inventory, or just cash in the bank, it's king in this process. And what you owe and how you handle that, what is owed, and how frequently you're paying that is critical to that process. We also see equity to assets. That means essentially what part of your balance sheet is owned 100%. Typically for mature pharmacies, it's going to be around 50%, give or take. Let's say 40 to 60%. For newer pharmacies, sometimes they have losses in earlier years. It takes them a while to get to 10 to 20% equity in those newer pharmacies. But you want to typically have, your goal should be to get about 50% of equity in those pharmacies. So these are really key things that you need to know what they are on an ongoing, continuous basis, so that again, you can use this to manage your pharmacy properly.
Yes, and that current ratio, when we're talking about the integrity in the balance sheet and each line item, that current ratio is going to be directly impacted by that. So if those numbers on the balance sheet or those items are not classified correctly, current assets or current liabilities, long-term liabilities, etc., that ratio is going to be off. And I can't tell you how important this ratio is. When any pharmacy that comes across my desk, I'm looking at that current ratio, and I'm going to gauge how strong the liquidity is in the pharmacy with that. And if it's below 2-to-1, I know we've got a lot of work to do. I know we need to talk to the client or talk to whoever and figure out what's going on. But if you definitely want to see that at least 2.5-to-1, if not higher. But this is just extremely important current ratio, extremely important key performance indicator. And that equity to assets is also important. So, if you're a pharmacy out there and you got a strong current ratio of 3-to-1 or 4-to-1, whatever it may be, and you got a strong equity to assets, in other words, most of your assets, or at least 50% of your assets, are paid for already. You've got a pretty solid balance sheet, and you're going to be able to take that balance sheet and really have flexibility with maybe you're interested in adding other pharmacies or growing your brand, etc. A strong balance sheet is going to give you that flexibility to be able to do that.
And Scotty, one other thing for those out here that are listening that have PPP loans and or SBA loans, as you know, what you're trying to do is to get those PPP loans forgiven. That will not be taxable income to you, and that essentially will wind up in the equity, which builds up the cash and liquidity ratios on your pharmacy. And again, those of you that have the SBA 7A loans or 504 series loans, essentially 6 months of payments are being made for you by the government. That and so that principal and interest that's being paid for you by the government, again, is not going to be a deduction for tax purposes. It is going to filter back into the equity and cash flow of the business. So this is a wonderful opportunity right now for pharmacies who maximize their PPP loans and who have SBA loans outstanding on their balance sheets to boost up their balance sheets and their equity and their working capital positions in an environment, in a COVID environment that's unlike anything we've seen in my lifetime. These are key components of your equity and cash ratios here that are going to be important as we go forward this year.
Mm-hmm. And we've touched on that gross margin, why that's so important. Those high performing pharmacies are seeing margins higher than 24%, which is about the average. So diversifying those revenues, finding out what it is you're doing, getting that number accurate is going to help you really expand on that for sure. We're seeing DIR fees obviously are a significant portion of expenses in a pharmacy, and we're seeing about 1.8% to 4.5% of your revenue is going to be a DIR fee expense. And like Ollin said, those pharmacies under 2% there, they have 5-star ratings across the board. They're doing things a little different with DIR fees. They actually are saying you can control DIR fees to a certain extent, and they prove it by their DIR fee percentage here. If you're not tracking DIR fees, you have no clue where you stand here. You need to start, picking this up. These are important figures you can capture, learn why your numbers might be higher, and what you can do to hopefully control that, like other pharmacies are doing. Gross payroll is a major key performance indicator. Usually outside of cost of goods, gross payroll is going to be your biggest expense. Industry average is around 10.5% of total revenue. And we like to see pharmacies in the single digits for revenue, or for gross payroll as a percent of revenue. And if you're talking 1% of a $4 million pharmacy, whatever it may be, you're talking about a whole lot of money. So this is a big area where you can analyze payroll, understand your hours, understand your rates, your staffing levels, and get a sense of how to manage your payroll to a maximum degree to get this down into single digit percentages. there's definitely pharmacies out there that are in the single digits. So we like to see that as a benchmark. Overhead is a percent of revenues, and also another one we like to track. This is essentially your total expenses, and we subtract out your payroll because we're already tracking that separately. We subtract out DIR fees, depreciation, amortization, and interest. And when you subtract all that out, you get really your overhead, which is all the other expenses in the pharmacy. And typically we like to see that in the 68% range. Clearly, the lower the number, the more efficient you are as far as an overhead perspective, as far as managing the ancillary costs in the pharmacy, so to speak. So we like to see that number in the 6 to 8% range. And then bottom line is 4 to 7% is around the industry norm. As far as a healthy bottom line, around that 4 to 7%. Okay. Now, you know, we're talking about maximizing value and cash flow, so we have to talk about some cash or some tax planning items. And, you know, we're still seeing pharmacies out there that are still on the accrual accounting for tax purposes. As part of the Tax Cuts and Jobs Act of 2017, the IRS now says, or Congress said, you know, you can report on the cash method of accounting. This was not applicable in years past, even though many pharmacies were still on the cash accounting method. So if you're already on it, no luck to you here. But for those pharmacies that were on accrual, you know, you can go cash accounting now. And when you're talking about going from accrual to cash, you're typically going to see a large expense as a result, because you're writing off those receivables, those third-party receivables that are usually in the range of $250,000, $350,000 on average, and you're able to write that off, which is going to create a pretty big expense when you net everything together. So a big planning tip here, if you're not aware what this is, you need to check it out. But we're talking cash flow, and tax planning is all about, you know, minimizing what you're paying to the government and keeping in the pharmacy. So accrual to cash accounting is a major one. Depreciation is very big as well. You know, writing off capital expenditures. If you need new equipment, if you need a new robot, if you need improvements, you know, planning around depreciation, writing that off, reducing your taxable income is a big planning tool, and that dives into cost segregation as well. If you own the building of your pharmacy, you know, looking at a cost segregation study is a big planning tool as well, a major planning tool, I should say, where you can essentially, buildings are depreciated or written off over 39 years, but if you do a cost segregation study, it segregates the building into components, and those components are grouped into items that can be depreciated much, much faster than 39 years. So you might have a tranche in the 5-year, tranche in the 15-year categories, and the depreciation rules for those 5-year and 15-year categories are very aggressive, very liberal. You can write off most of that in year 1. So we're talking about depreciating significant amount of that building in a year or two, and reducing your taxable income significantly. So huge planning tool there.
Scotty, I had one this morning, $700,000 upfit last year, and 48% of that is a 5-year depreciable asset now. The remainder of it's 39.5 years. So that's exactly what we're talking about. He'll be able to essentially write off most of that very quickly versus the bulk of it over 39.5 years. It makes a tremendous difference in your cash flow.
Huge difference. In that example you just did, 5 years, about $350,000, 50% of 700 would be able to be written off perhaps in year 1.
Correct.
For that pharmacy. And so that would eliminate most income for all pharmacies right there. Of course, you got buy-sell tax considerations. If you're looking at buying and selling, there's definitely some tax considerations that you can consider where you can maximize. Yeah, you can maximize your situation here. Go ahead.
Let me just say, if you're looking at buying or selling, don't decide on a valuation before you put the deal together. Talk to somebody who deals with pharmacy acquisition and purchases. That's somebody other than a broker trying to make a commission. talk to somebody who deals with acquisitions and mergers. Somebody like that deals in these kinds of things can save you a tremendous amount of money. And in some cases, it'll let you buy, for example, an S corporation that's been in business 5 years and keep the entity as a whole, and essentially write off the fair market value of the assets very quickly. There's just all kinds of opportunities available there, as in the charity planning area. And Scotty, we're running out of time here, so
Yep.
why don't you take 199 real quick, and I'll take retirement plan.
Sure. Section 199A deduction is available as well. You want to make sure you're taking advantage of that. Pharmacies are eligible for that. I saw a tax return the other day from another tax preparer where they said they were not eligible for this deduction. Pharmacies are available for this deduction, and as a matter of fact, we work with the NCPA directly to make sure pharmacies were eligible here. And so, you are eligible. Go back and check your tax return on that. Charity planning has been revised completely for 2020. You can now write off up to almost 100% or up to 100% of your AGI for charity. So there's going to be a big planning year for charity if you're charity inclined this year.
And on the retirement planning side, if you haven't looked at a cash balance plan, if you have little debt, you hadn't properly planned for retirement, i.e. saying you maybe have a SEP or a simple, which is not really much to put into a plan, you can take a look at a 401k safe harbor with a discretionary profit sharing plan with an optional cash balance plan. You can put tremendous upwards of $250,000 plus a year into that plan if you have the cash flow to do it and have relatively little debt. It's not for everybody, but in certain cases it applies very, very well.
So it wouldn't be a webinar today if we didn't talk about COVID-19 and the pandemic, of course. And clearly, you've got the PPP loans that are available today. There's still $100 billion left in that, which can be used to pay payroll, rent, utilities, interest, etc. So you've got some cash flow options available right now. Economic injury disaster loans, although these are only now available for agriculture. They've kind of cut off everybody, but keep checking back here.
They're going to open the door back and it's going to allow a loan of 30 years, 3 3/4%, no
Yep.
personal guarantee for $150,000. It's going to take you some time to get there, but keep checking SBA.gov for EIDL loans every day, and that's going to open back up, is our understanding. And the SBA loan forbearance is, you already are aware of that if you have an SBA loan, because your payments are being paid for 6 months starting from April through August.
That's right. Well, that looks like we're coming up on time. Hopefully maybe take a question or two, but we certainly appreciate the opportunity to be here today.
Absolutely, we appreciate the opportunity. And while we're waiting for you to queue of any questions, if you have questions, you can send us an email, ask Sykes at sykes-cpa.com. That's SYKES. We'll do our best to try to answer these questions after we get offline. So are there any questions we can help answer?
Yeah, actually, this is Tracy. We've got quite a queue built up here, so I know that we probably won't be able to get through everything during the time we have allotted today. So I'll make sure that I pull these off and send them to you for follow-up. There were a lot of questions related to DIR fees, so I'm paraphrasing them, but a lot of them are, how do we understand or account for our DIR fee responsibility when we don't know what it'll be for 2 to 4 months down the road?
Well, it's almost an impossibility to determine, because with the exception of CVS Caremark, they're clawing back on a trimester basis during the course of the year. Most other third parties are doing this monthly now, is our understanding, and most third party reconciliations are capturing the information they're receiving from the third parties. And again, you have that report each month. We don't have it at point of sale. NCPA is working hard to get it at point of sale. It's not quite there, but at least you have the report that you can get from these systems and make the recording into the accounting system, as we discussed earlier in the conversation.
Okay, thank you. Are you familiar with IRS Section 1202 for tax treatment of dividends for small business? The accountant we're working with told us that pharmacies are specifically excluded. Would you agree with that?
1202 is not ringing a bell for me, Scotty. How about you?
I need more information on that in particular.
If somebody could just send us that question, send that to Ask Sykes at Sykes-CPA.com.
Sure, I'll send that one along then.
Okay.
What are some of the inventory management systems you've seen that are a good value? And then as a corollary to that, we're on perpetual inventory, but it's difficult to maintain. Any thoughts on that?
Yeah, we hear of that a lot of times. It is difficult to maintain, but somebody's got to take responsibility in the pharmacy. Can I mention brand names?
Absolutely.
Okay. Two systems that are out there in the marketplace that we see are Data Rhythm and P4Tech.com. They're two systems that we see in the marketplace. Also, LeaderNet, I think, has a system that they market as well. For those of you that need inventory assistance and help, we like inventoryiq.net. That's inventoryiq.net. They do a great job as far as helping you set up a perpetual system and getting that set up and controlled. They also go all over the country as we do. And Scotty, anything you want to add to that?
No, I think you covered it on that.
Okay, thank you. Question about the 835 files. Do I not need to assume that they are accurate?
Well, the 835s that you're receiving, you have to assume that they're accurate. But our point is, once you get the 835 files, you've got to verify those deposits that you're getting back to your third-party reconciliation systems that are out there. Otherwise, your third-party receivable systems are going to be off potentially dramatically.
Okay. Next one. I book accrual cost of goods for purchases, drugs, and use revenue for purchases, parentheses, drugs, and use revenue for only prescriptions gone out of pharmacy to figure out my gross margins. Is my thinking correct? So accrual cost of goods for drugs, but revenue for prescriptions out of the pharmacy.
So your cash basis revenue and accrual basis cost of goods. So you're going to have a skewed gross margin in that case. Your revenue is going to be lower, your cost of goods will be higher, your margin will be lower. So you're having a skewed key data point there, and I don't know if you're capturing DIR fee in that revenue number or not, so that's going to skew it even more. So we like to see that revenue number accrual with the third-party receivables adjusted into it, the inventory or the cost of goods number accrual as well with inventory numbers adjusted into it, and then DIR fees booked into the revenue number and expensed out on the expense section. That's what you want to aim for.
Okay, thank you. And I think we've got time for one more, and then we'll wrap things up. I'm not an owner. Does the gross margin of 24% include rebates?
Yes.
Okay, easy enough. All right.